Hey everyone, me Kevin here. The stock market is an absolute crap show right now, and in this video I'm going to explain what we could actually be facing and how long we might actually be facing it for, and how to look at this market in terms of an investor. It's very different than the market we were looking at in 2020, and I want to explain some of those differences in this video. But first, I want to provide you another update on this right here. This is the Bloomberg Research Terminal two-factor identification code thingy-majiggy, and when I swipe my finger on this and verify my fingerprint and then scan a random sort of little flashy thing on my computer, I end up getting a 4-digit code. The very first time I got an odd code was February 19th of 2021, and it was pre, and the stock market basically collapsed into March and May right after that update. In fact, the market started falling basically right after it said PRAY. You look at Feb 19th, 2021 in tech stocks and it's freaking scary, okay? Well, then come about the second week of January, I got SH9T, which 9, if you look at the 9th letter of the alphabet, you end up replacing that 9 with that 9th letter of the alphabet, you get I, so you get SHIT. Yeah, well, the market's been absolute doo-doo as well since the middle of January. Now, this time it didn't tell me as early, like it'd be nice if it would have told me in December, right? But this morning I got a very interesting update, and it was NAPP. NAP. And it made me think, okay, I'm not a very superstitious person, but it just made me think, what time in history is similar to what we might be experiencing now? In other words, when is the frickin' pain potentially going to end? And how do we invest differently now than we did in 2020? Well, that is what we're going to talk about in this video. But first, I want to give a shout out to public.com because they just partnered with Otis. Now, you've heard me talk about both of these companies before, and now they're teaming up together. See, Otis pioneered a fractional investing platform for NFTs, arts, and collectibles. And now with Otis joining Public, which is that investment brokerage that you can invest with, you can work with the community by discussing your principles for buying and selling with the public community, which is really neat. Every time you buy and sell, there are over 3 million users in the public community, and the public app will soon be one of the few apps in the world where people can actually invest in diverse assets and build a modern portfolio, so that way you can invest in that fractional NFT, art, collectible space as well as stocks. So it's really, really cool, especially since in the future they'll be adding real estate. They've already got crypto, they've got different funds you can invest in, all in the same place. So it's pretty neat. The Otis integration is coming soon, so sign up now via the link down below, and you could end up getting a stock worth all the way up to $1,000 when you go to metkevin.com/public. Check that out, linked down below, metkevin.com/public. Okay, so here's kind of what I was looking at in terms of research. So right now, when we look at the QQQ, we look and we say, oh my gosh, okay, all-time highs, we're beginning of January, we had a lot of exciting sentiment, and so what are we doing now? We're throwing these Fibonacci lines up, and we're realizing we're starting to kind of fall and close below these Fibonaccis. In fact, today, we ended up closing right here at 330, which is below the 0% 334 line. So it's getting to the point where I'm starting to have to actually move my fibs down. I haven't actually moved these down yet because part of me is a little bit in disbelief that the SPY has broken this twice and we're about to break below it again. The 0% fib on the SPY is 420, we're at 423, okay? We are just straight up trending straight down. And it sucks. I mean, this is a horrible trend pattern. And when we look at the chart like this, we think to ourselves, oh, come on, how long can this last? Because when we zoom out on the day chart for the SPY, I mean, look at the chart. We had this short crisis of a dip over here in March of 2020. And yeah, we've had these little fear opportunities over here to buy. And every time we've gotten under the 100-day moving average on the SPY, it was a buying opportunity. It was a buying opportunity in March of 2020. It was a buying opportunity right before the election over here in 2020. Anytime we had here the pain that we had over here in October of 2021, that ended up being a buying opportunity. It would seem like now is a buying opportunity now as well, but what's different? What's different, and what does it signal for the future of this market? Well, what's different is during all of these short-term falls, Jerome Powell was our friend. The Federal Reserve was actively printing money like crazy, making it so that all of the investments we made, no matter how stupid they were or how little research we actually did into them, and don't feel bad for it, it was what worked back then, okay? I like to do a lot of research, but I know a lot of people pick stocks don't do any research, and they can do very well. But this time is actually different. Now, I hate using that phrase, this time is different, because this, that is 2022, is different from 2020 and 2021. In fact, that we do not have JPOW blowing wind at our back. We make a bad choice and a company misses earnings. You know what happens right now? You end up getting docusigned, or you end up getting Rivianed. I mean, look at this. This is an absolute cluster F. You go from $314 down to $90 right now. That is insane. Actually, I'm sorry. That doesn't even incorporate the after hours price. We went from $350, or sorry, what was it? Let's see here. It's so bad. I can't even remember. The high was $315. The after hours actually has DocuSign at $78. So $78 divided by $315. Look at that. That's a decline of 75%. Look at Rivian, folks. It in after hours is at $36. It's straight down. I mean, this looks as bad as the Robinhood chart. Now, fortunately, I sold my DocuSign. Fortunately, I never bought Rivian. I made a video right before the run-up, and I said, should you buy Rivian? And everybody thought I was an idiot when I said the thing was overvalued, and the thing kept running up, and I'm like, oh, whatever, make some money shorting it. Okay, you know, it's gone down substantially, right? Why? Because we don't have the wind at our back. So, of the Fed, right? But look at this, because this is scary. We're looking at this chart, and I know this sounds a little fuddy, okay, but look at this chart. This right here implies that we've had a massive downswing here, and maybe we're close to the bottom. Maybe it's time to buy, right? But then I got a little nervous when I did the following. I went to TradingView, okay? And when I went to TradingView, what I did is I turned on the log chart, and I went all the way out to throw this up here on the single day, and I threw this out at all time. And if you do that, it actually bounces it out to a month, which is fine because it's such a long term. And what I wanted to do is I wanted to compare us to the dot-com bubble, because there's so many comparisons to the dot-com bubble right now. And this is kind of scary because when we look at a lot of the SPACs, a lot of the profitless tech companies, a lot of the really innovative plays that were big game changers as well back in the dot-com bubble, remember a lot of those though unfortunately did go bankrupt, we saw a similar kind of drawdown in prices of a lot of these companies now. Again, the DocuSigns, the PayPal, the SoFi, the Square, the Lemonade Insurance. I mean, InsurTech has gotten destroyed. A lot of the EVs have gotten destroyed. Some of these companies are down 60 to 80%. It's absolutely crazy, right? Very similar to the dot-com bubble. And so this is what woke me up to thinking, wow, maybe we got to look and compare to the dot-com bubble. And take a look at this. And this is really what was scary. Look at when my TradingView Bollinger Bands here gave me a sell indicator going all the way back to 2000. It gives me a sell indicator after we've already had some pain here around January of 2001. Now that's wild because the dot-com bubble really started having pain in about September of 2000. And so it was kind of late. It was almost like, oh my gosh, well, if you would have sold, January of 01, you would have sold at the bottom. What a loser, right? And this is very frequently what we hear when people say they're selling their stocks. It's like, haha, stocks just went up the next day or the next week. What a loser, right? But look at this. Had you sold here, you would have actually saved not a few weeks of pain, but you would have saved almost 2.25 years of pain, leading all the way to where the buy signal pops in right here in about mid-2003. How wild is this? That we had 2.5 years of pain of the dot-com bubble. That would be from about the end of 2000 to the beginning of 2003. 2.5 years of this kind of garbage. And when I throw this on a log chart, which what's really important about the log chart to know is it shows you a relative percentage decline rather than just a nominal price change. Because over time, as prices get larger, it seems like the chart moves more than it actually does. Like, for example, if I go over here to Webull, just to make this make more sense, I go to the month chart. This is the dot-com bubble right here. And it feels like what we're experiencing right now is actually much worse. But that's because we're starting with larger numbers, right? We're starting with a number here of 100. We went from 100 on QQQ down to 20. That's an 80% loss on QQQ. 80 freaking percent. But if you look at the chart, it's like, wait a minute. The chart makes it seem like this is a much larger decline, right? But wait a minute. The SPY's only gone from 408 or we'll call it 409 to 312. That's only 20, I mean, not the SPY, the NASDAQ. It's only gone down about 23.7%. So why does a 23.7% decline over here feel bigger than an 80% decline over here? Well, again, it's because we're starting with larger numbers. So the drop, the candlestick drop of 100 points is obviously larger here because 100 points here would bring you to zero, right? Like, kind of wild. Anyway, you could solve for this by looking at the log chart. And this is really what is kind of making me a little bit nervous, I have to say. Makes me want to sign up for life insurance. Anyway, look at this, okay? I've got the log chart on. Look under my head right here. See how it says log right here? Look at how our dip right now compares on the log chart. That's it, folks. Look at that right there. How ugly is that? That's it. This little itty bitty little red right here, the cute little bit of red. That's the pain we're dealing with right now. That's what everybody's freaking out about right now, okay? You want to see real pain? If we're really comparing ourselves to the dot-com bubble, look at that. Holy crapolas. Okay, so what do we do with this information? Because obviously we know that we've got a lot of maddening things happening in the economy right now, okay? We've got insane levels of inflation. The Federal Reserve is stuck between a rock and a hard place. In the short term, they're not going to rug pull us. They're not going to 50 basis point hike us. They're not going to shock and awe us. They're going to stay accommodative by doing 25 basis point hikes. This is almost certain. I could be wrong. Data could change, but the Federal Reserve has made this very, very clear to us because of war and the geopolitical concerns. They are going to relax. Now, this is good, but it still doesn't necessarily mean they're our friend. I mean, they went from being our friend to blowing wind at our back to, like, kind of blowing wind against us. They're just saying we're not going to huff and puff you. We're just going to slowly blow you. I hope nobody clips this. Okay, so now we've got to consider the fact that, all right, inflation, if it doesn't go down, they're going to eventually have to shock and awe us. They will have to force a recession to get inflation gone. And it's important to know that they can do this. They could wave a wand and create a recession. All they have to do is jack interest rates up to probably 6% instantaneously. Inflation will go away virtually overnight because demand will absolutely collapse. We'll go into a recession that will be very painful. Real estate prices, stock prices, everything will be hurt. There'll be nothing that'll be safe. People are like, oh, but crypto will be safe, right? No. NFTs, crypto won't be safe either. Gold might not even necessarily be safe. Honestly, the best thing that'll be safe in a recession is straight up cash. And I'm tired of hearing people say things like, oh, but cash loses value to inflation. Dude, it depends what you're buying, okay? If you're buying things that are going down in value, you gain money. It's like having deflation, right? That's the point, right? Your cash gets more valuable as prices go down. Anyway, so we still have the boogeyman of inflation. And if it does not end up being transitory, and you do not believe that in 1 year from now, inflation has gone down with the Fed raising rates 25 basis points, 7 or 8, or maybe even up to 17 times in a row, then you probably don't want to be in equities because the Fed's going to have to keep tightening the screws on us until this inflation is gone. And if the inflation stays, they will have to force a recession. But I think the big sort of scary thing for me, and this hasn't changed my portfolio. It's not like this is making me want to like flip or whatever. I'm about 72, 73% exposed right now to the market. And a lot of that was because the shock and awe potential of the Fed has gone away. In fact, you know, it was wild because people always tell me like, oh, why didn't you tell me this earlier? I did. I literally do. In fact, look at this. This was so scary. I looked at the January CPI spreadsheet the document I had from January. This came out February 10th. See, it says right there, February 10th. So I probably did a video on this on February 10th. But anyway, I was talking about how there could be a 70% buying opportunity, and you maybe want to be 30% cash. And that's literally what I did. Like, I do try to be as transparent as possible on this channel. I pretty much do what I say I'm going to do. That might not be what sometimes we want to hear. Like, obviously, nobody wanted to hear that Kevin was selling. I'm very grateful that I did because I saved a lot of money. And I know today was a red day. I was up this morning. Well, actually, last night I was up since my trades by around March 24th. I was up about $1.2 million in my portfolio. Now I'm only up 800. I'll still take the 800, though. Don't get me wrong. I'll still take the 800. But I am very sad about looking at this log chart because I'm like, we could just be going through, quite frankly, nap time. And that brings us full circle to this Bloomberg notification here. And that is going full circle back to the next, quite frankly, at least year, if not year and a half, could end up being nap time. And nap time is an opportunity for you, in my opinion, to build. Okay, this is an opportunity to figure out how you can make more money. For example, those of you in my Path to Wealth course, how can we figure out how to make more money, negotiate a higher salary for you, make sure that you're able to invest as much as possible, increase that top line so we get more into the bucket of investing, right? And then when we have more in that bucket of investing, how can we invest this in the most conservative means possible so that way we can get through this storm? Whether we're buying wedge deals, below market wedge deals, whether we're allocating more money to cash than ever before, whether we're making sure to stay out of debt, whether we're also doing some things to potentially yield farm, selling puts, selling calls. Selling calls, potentially a little bit safer in this sort of market. I know that sounds crazy because worst case scenario with a sold call, you end up losing your shares because you're selling them at a certain price you agreed to. With sell puts though, if you end up selling a put and then the market keeps going down and down and down, it could hurt because you're really agreeing to pay a certain price. So for example, on docusign, there, if we go to the day chart on DocuSign, if you sold puts after this drop over here at 150 and you're like, oh, the yield's so great, I'm going to yield farm over here. Now it's down another 50%. Your puts are bleeding like crazy. But look at it, it's down 17% in after hours. It's insane. So what do we do? How do we stay away from the most dangerous categories? Well, it seems like the biggest pain points in the market right now are companies that are in the financial space, SoFi Square, companies that are in the stay-at-home space, Zoom, DocuSign, companies that have no profit without a doubt, companies that are SPACs, no matter what they are, and healthcare to some degree. And this is kind of sad that you kind of, like, it's almost like nobody's doing fundamental analysis. It kind of feels like these things are just being lumped together, and then the algos are just going sell, 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 sell on those things. It kind of sucks. You know, things that are holding up okay. I can't really say that Tesla's holding up okay because look, I mean, it's on a straight downtrend, right? Things that have held up okay to some degree, obviously at this point, energy, but this could be a short-term play, but it could be a hedge against some of your other moves. Personally, I think these trades are crowded. Once the geopolitical crisis ends, I expect this trade to collapse. Same thing with wheat, and we've already seen some of the commodities start collapsing. I expect that trend to continue. So rather than going too heavy on energy or commodities or wheat, for me, it's not financial advice for you. I'm a little bit more interested in just being cash heavy on those, or potentially trying to do 2 to maybe 8 week sold puts, grab a little bit of yield farm. Worst case, I have to buy those shares. That's okay. But I'll also sell some calls. In fact, probably if tomorrow we get a little bit of a green day, I'll sell some calls again against some of my positions that are a little bit higher. And that way I'm just collecting a little bit more cash. So that way I'm prepared. So hopefully once we get through this next year or whatever, if we could just honestly get through this year flat or slightly up, that's going to be a good thing. I hate to say that for broadly, right? I hope to be much more than obviously flat or slightly up. I hopefully can still, with yield farming and the strategies that I have, return somewhere between 10 and 30%. That would be wonderful. I don't have the 2020 expectations anymore of, oh yeah, everything's going to double in 3 months, right? This is why call options, in my opinion, are dangerous. And I'd rather have shares than in the money calls in this kind of market. But a lot of people are coming to me and they're like, Kevin, when is skills going to go back up? When are, insert popular 2020 stock in here going to go back up? They don't have to go back up. And this is, I hate to say it, but penny stocks are not IPO'd. Nobody IPOs a penny stock. Penny stocks are created by the market. Look at this. Skills went up to $46 out of momentum. It's at $2 right now. $2.10 divided by 46. It is down over 95%. That's freaking insane. But this kind of stuff will keep happening. I know NEO is one of our sexy friends. We just love NEO. But I can't buy NEO because I know the Chinese consumer is sucking right now. The darn thing's going straight freaking down. Now, I get it. Tesla's been having a little bit of a rough ride too, but certainly not as rough as what we've seen at some of these other plays. So, look, just be careful. That's all I have to say. Go for those high growth, high margin businesses. That's what I'm personally looking for. So what are my favorites? You should know this by now. And I trade other ones as well, but some of my favorites. Honestly, Visa. high margin, 50% of the bottom line. I wouldn't say massive growth, probably like 8 to 12% growth, right? Tesla, 50% growth, huge growth and profitable. Profitable growth is where it's at. Enphase, really amazing. Companies like this, even Google to some degree, high growth, high profit, free cash flow. That's what people are investing for right now. But I hate to say it, I don't know with certainty that it's going to save us from this. So while right now I'm in and I'm not flipping, I just want to provide this logarithmic comparison here that quite frankly makes me sad, because I do think the next 2 years are going to be more painful than not. It's certainly 2020. 2020 is going to suck, but we've known that for a while. So anyway, just some thoughts. Thanks so much for watching, and we'll see you in the next one. Bye.